Let me now bring the Mr. Maverick on TV. Sameer Arora. Oh ji, new glasses, kya baat hai?
आपके लिए how much effort I put in just for you.
You know, I am reaching that age where I am getting my eyes tested. दूर और पास का दोनों का कम दिखने लगता है. So I don't know what is the story behind your glasses.
I told you my glasses are because I'm benchmarking Mr. Rani. So he had one of these, I bought two of these.
You know, when he started wearing those glasses, market started falling. I don't know if you remember. So now that you're wearing these glasses, I don't know what will happen.
After November, yeah.
So look through your fancy glasses and tell us where do you see markets are headed.
So markets are okay. Okay means ki I don't like this other end of the guys who say, "Arey, this is the 25 years of India and the Amrit Kal of India." So that is like over dramatizing, overselling. But the fact that you can imagine continuing the GDP growth at 6-7% and that you are helped by flows and you are helped by this fact that if India finally, after 2-3 days every day when you guys say to get ready for tariff response and all, that if we really get away with lower than China, lower than Bangladesh, lower than Sri Lanka, lower than Japan, EU, whatever, if we get 10-15%, then that help on the other side. Plus the fiscal deficit is in control, the interest rate, inflation, liquidity, all that is good. But nothing is that attractive that you should make 20-25%. Isliye we say it's okay. Okay means you'll get decent return. You don't have to always make much more than the underlying earnings growth. It's not that you can get PE re-rating, but you can continue with the earnings growth reflecting in stock prices.
So for markets now to move higher, what could be that trigger? I mean, markets have got much more than what we thought they would get in the month of April. Liquidity is back, rates have come down, monsoon has been good. Tariff so far appears that there would be a sensible application.
And relatively, India would be better off.
Yeah. But yet from April, markets are just not going anywhere. If not April, at least May, June. So if the news is favorable.
So but it's okay now in the sense that the market will be up 4-5% year to date. I consider year to date as calendar year to date. So that's what I'm saying. I'm imagining or expecting only 10-12% per annum for 1 or 2 years or at least 1 year. Then the earnings have to grow much more than they are. Currently, there are two big chunks of the market which are not growing in earnings. One is the IT sector and one is the large consumer sector. So they have to grow from their 3-5% to 8-10%, then the whole thing can get a boost. And maybe the financial sector, particular large banks and all, whose earnings in this one quarter and maybe second quarter will be 8-10%, they have to go back to the 14-15%, which will happen, over after a few quarters, after this NIM pressure goes away. So these 2-3 big chunks of the market are not growing at 15%. Normally they used to. But they may not go back to 15, but they can go between 10 and 15, and that is fair to expect and not unreasonable. But that is enough for you to be fully interested in equities. Now, if in the end you get more, great. But we don't have to start by imagining or selling or overselling that you're going to make 20% per annum, but you can make 10-15% per annum.
When we
so it's the last 6 months. In the end are basically going along with that expectation only, although first 1 or 2 months were bad, but overall it's up whatever, 5-6%, I think 7%. So theek hai in 6-7 months.
So last time when we spoke to you, you said markets are looking okay and banks are looking good. Are banks looking good?
No, I'm not saying banks are looking good. I'm saying for the overall market to do better, these 3 pools have to grow at higher rates than they are currently. But we continue with the banks we have. Of course, we have been pained a lot by our number one holding for the last 3-4 years, or maybe 4-5 years. But last year it's been okay. Even year to date, it's okay. So it's okay. It's another of these okay. Not every stock is going to give me 20-25%, but I don't think that the market is going to be that. So a few stocks we hope will give, and the rest will be, as long as they outperform by 1 or 2-3% also, it's okay.
All right. Hi, Sameer. Morning. This is Shrishti also joining in. But Sameer, help us with your take on the IT space as well, because as far as I remember, same quarter last year, you were quite bullish on the overall overall space, but off late, you guess you're not expecting much of the IT space and you have sold off there. Give us your sense.
So I don't know about last year, but this year from Feb, we have only one stock
All
everywhere.
right, but any hopes
We
from
don't
the
like
earnings
IT
season?
because it's been disrupted. Sorry?
Any hopes from the earnings season? Are you still
No, we
looking
don't have
for
hope. Of
opportunities?
course, there can be hope in the sense that positioning is very light and nobody is bullish. ये सब बातें, I don't play that technical a thing. But big picture, if you grow instead of 3%, you want to grow 4%, okay, great for a technical reaction. But the bottom line is that A, the US uncertainty has not gone away. And B, I mean, is it not enough to see every day, day after day, that things that you thought were being done by human beings are now being done by AI and basically new tech or new technology? Even drivers are losing their jobs. The Microsoft type guys who are growing a lot are firing employees. You can see Meta firing employees, and on the other hand, paying hundreds of $1 million for some employees. So the whole sector is in flux. And if you really look at it philosophically and conceptually, that biggest attack is on India actually. Because what is the role of AI in its purest sense? Two things. One is to do things which human beings could not do as well. Things like, I don't know, weather forecasting, or let's say some drug discovery or something. Okay, that's great. It is adding. And the other one is what? The other one is to replace human beings. There's no third reason for doing AI. It is to replace human beings. Now you can say, and this is what these companies say and the bulls say, that if you see the last 3 or 4 rounds, whether it was 2000 or then it was cloud and then it was this and then it was that the people discovered new things to do. And therefore, in the end, jobs were not lost, businesses continued to grow. Here, the only thing is that one of the objectives, according to me, core objective, is to replace the human being. It is not a side. It's not a side issue that, as part of doing something else, you replace the human effort. No, that is the main effort. And the second one, which is for a smaller part, is to do things which humans could not do. Okay, so wala part you can say will continue. But the other argument is that in the beginning, companies will need to, get advice or work done on moving faster to cloud, on what data set to use, what AI to use. So I call this like if you saw the multiplex companies from 21, people knew that it's been disrupted by OTT, but every day some analyst would come and say, but this month you see Superman is coming, and this month some Pushpa 2 is releasing, therefore this month is very good. We have to see big picture philosophically. It's been disrupted now. That doesn't mean next quarter I won't have one share here or there, but big picture, it is not any great sector according to me.
Indeed, point taken. But Samir, off late.
Not IT services I'm talking about. IT is great. IT services. It relies on billing of people.
But Samir, the other point I wanted to understand from you, that how do you see the whole FII fund flows coming into India? Because off late, they have also dried up. Do you believe that the FIIs are now waiting for some more clarity with respect to earnings, the tariff maybe, or the Jane Street event has some implications on the fund flows?
Jane Street has a very positive impact. Jane Street was blatantly rigging. There's no need to do much discussion on that. That is just too obvious. So that the regular FII, I will like it. That has been cleaned up. But the FII flows, the big story is as follows, that for the last many years, US gets about 70% of world equity flows. If you say broadly that the MSCI World Index has some 65-68% in US. And this before GFC, because after GFC, US really outperformed the rest of the world. The longer term average was about 55%. So according to me, and according to whatever I read, and according to what I do myself in my global fund, nobody is willing to put 70% in US anymore. And this is across the world. You just type 3 lines and you'll see hundreds of articles on this, that how ex-US ETF. There's an ETF World Index ex-US, how it has suddenly started getting billions of dollars and so many interviews, so much. So if big picture, the rest of the world or even the US guys think that they should put 3%, 2%, 5% less in US, because anyway the number is very big, 67, 68%, then that 3-4% has to go to the balance 33% of the market or the weight. And so if you have any credible story in that outside US, in which India has, you will get more than 10-15% extra flow, because your 33, 34, whatever, 35% weighted countries are going to get, if not in 1 year, 2 year, 3, 4, 5% extra. So the outflows have stopped, according to me, and the inflows will happen slowly or faster, but it is a matter of time, because there is a limit to how much you can push US exposure in a global portfolio. And even a US guy does global portfolios, so it's not only non-US guys you have to buy.
Right.
And so that happens, in India has a strong case to be one of the, not only in a macro sense beneficiary of that, but within that category be little higher than some of the others, if not all of the others, and therefore you should get flows, FII flows, according to me. Yes.
Okay, so sounding good over there, Sameer. I'm on.
And that would be a good situation, because for the last 2-3 years the issue was, by the way, in the last 20 odd years there have been only 4 negative years, and out of that 4, 2 have been the last 2 out of the 3 years. So if the FI just stops selling and the Indian guy is anyway buying, even that is enough. But even if both are buying, which is great, separately we have to remember that we can't have a massive rally, and if it is, then that would make a situation like, in the early part of this year, ki too much valuation ho gaya and the earnings are not coming. Therefore, expectations are, say, 10-15% return. For that, we have enough FI money that will come in.
Okay. Hi, Sameer. Morning. This is Nehi also joining in the conversation. Sameer, you've always liked new age companies and you have been bullish on the entire quick delivery, quick commerce space. Tell us if that conviction still continues now that competition is heating up. Actually,
it has increased because one of them has not heated up, it has melted down, which is called Zepto. So therefore, and if in fact, the point is that it is very clear from data that you can see on downloads of apps and this thing on discounts, that the pressure has reduced. And also, don't call it quick commerce and confuse the public. It is a retailing business. So in retailing, India is selling about 500 billion of this stuff, and these guys are selling combined some $8-10 billion. And so therefore, if somebody is at 10 billion and the market is 500 billion, so if he grows 3, 5, 10%, 20% more than the other, or 100% for a few years, it doesn't mean anything. It is a big market. It's just like any other retailing. And mostly if you see in the world, retailing companies are the biggest companies like Walmart, Amazon. Amazon is a retailer. We don't call it a tech company. It's a retailer. So India में retailing में यही 5 कंपनियां, आप चाहे उधर से आप बोले लो DMart, or this side you take Zomato, whatever. It is just a different mode that we have discovered based on our factors, that labor is cheap, that there is concentration of people, that we don't have massive refrigerators at home, that it is pollution is there and traffic issues are there and time is less because you spend. Yesterday I read that 5.5 hours it took for a guy to go from Gurgaon to Delhi. You are taking advantage of the fact that we have more people who need jobs, and it's that Indian thing, nothing to be surprised about the concept.
All right, Sameer, thank you very much. And
thank you.
Fancy glasses once again.
Now I have no news, and I'll be recycling these in my next interview.
See you. Take care. Bye-bye. All right, Samuel Mehta, 30 minutes into trade. What is popping up on your charts?